Welcome back, everyone. My name is John Kohler. It seems like just yesterday that it was February, but a lot has happened since February, and here we are getting ready for the summer in residence cohort. I'm introducing module 7.3, the last swing at the bat in order to get yourself on the path to investment readiness. We're going to talk a little bit about some things we presented in module 2, and we're going to see how you can wrap what you've done since then into a justifiable ask. Okay, so it probably is useful to present this first slide, which is the spectrum slide you saw in module 2. That talks about the fact that there are different kinds of money and different types of expectation depending on the type of social impact investor you're speaking to. So on the left-hand side of this graph, as you will remember, is more grant-making, program-related investments, moving into soft loans or what we would call concessionary investments. Those are the kinds of investment terms that probably are below market rate return for the investor, but one where they're very focused on the impact and positive, either social or environmental outcome that your business embodies. And then as you move to the right, it becomes a little bit more traditional with some financial expectations that increase. What I've added to this slide is the next slide, and that is with the same spectrum in mind, you can see that grant makers usually are looking at somewhere between 100% total loss of their invested capital to some grant makers who are willing to see some of their capital come back. Maybe it's after everyone else gets paid out in a blended financing, or perhaps they just earmark that they get 70% of their grant capital or 100% return on capital so that they can reinvest it in what we would call an evergreen kind of investment. Also, further to the right, you'll see that the expectations for impact investors is usually a return on capital with some kind of risk premium. And the further you go to the right with financial first investors, they're going to look across a blended portfolio of at least 8%. And then as you go to equity or private equity investors, they're going to be beyond 8% in terms of the financial return that they expect. So the question that I want to have you remember is, in your mind, what is the promise that you need to make to your prospective investor that your business model allows you to keep? That's where you then find yourself against this graph of expectations and returns. So one other slide that I would want to remind us of is that the impact investors many times will come along with an orientation towards achieving more impact even if a financial floor is not yet met, and that a financial investor will certainly travel along the axis which allows them to achieve a financial floor first, and then they'll move along the x-axis, meaning from left to right, to say how much of an impact can they achieve with at least a minimum amount of financial return as they've expected to yield from their portfolio. So depending on the kind of investor you're calling on, this is a great orientation for you to keep in mind as it relates to the promise that you need to make and hopefully get a handshake over as you do your financing. The next slide is kind of a fun slide. I like it. You know, it talks about that there are many different types of enterprises like yours, some of which allow access to energy, some of which allow access to food or better agricultural practices, some provide jobs that yield a dignified living, and some might be working on lowering rates of recidivism for criminals who come out of jails, and you want to lower the rate that they re-enter jails in. So all of those are different forms of impact or benefit that can be achieved through concerted effort. And yet we seem to use the same kind of financing in impact investing. That financing could be a convertible note, as you see in the bottom of the slide, or it could be an equity purchase. We think that, in fact, one of the considerations is to use blended structures or, in fact, structured exits, which are typically debt and not equity, and that might match better the business model and the return that is inherent into your company. On the next slide, I'm showing you really, you know, the difference here is that the area under the expense curve on the left-hand side of this chart is the capital need that you have. You've probably been working with your mentors on exactly this definition because you've had to figure out what your capital needs are, the amount that you need to ask for, and how you will invest it in your company to produce growth. Of course, after cash flow break even, and on the right-hand side is the amount of that revenue exceeds expenses, total expenses, and that's essentially the promise keeper. That's where you have some free cash flow that you can pay back your investors depending on the terms of investment. The point of this slide is that it is not just the type of business, but the stage of business that you have that defines which door you should be knocking on and what type of capital is appropriate. Okay, so let's go into a tool that will help you create the rubric cube, so to speak, the tool that will help you identify where the investors are that are most appropriate for you and your enterprise. There is a tool that when you come into the in-residence program that we can help you with and your mentors can help you with, that is essentially a list of over 190 investors. That list is growing. Mark Correnti, who's on our team here at GSBI, is furiously working on adding to this list and dimensioning it. But what you'll see is, in the slide following, is that some of the key points here are the size of the fund, what type of capital they lay out, where they like to operate or source their investments from, what type of investors they like to work with, and also what sectors they generally focus on in terms of deploying investment capital. So as you then turn to the next slide, I did a quick analysis on behalf of the two examples that Steve White was showing you. The first one is carbon roots. And when I ran the rubric against carbon roots, I used Latin America, not global, but Latin American investors who were interested in agriculture or energy, and then who were willing to supply debt to the social enterprises that fit that criteria. And I came up with the list that you see here. This is only for example. I mean, obviously, Carbon Roots has already taken advantage of this and has been fundraising and has received funding from last year's cohort, but we hope to do the same kind of exercise with you. The other one is Practice Makes Perfect. I ran the same kind of analysis against our investor database. This one is US only investors who were interested in education and were willing to supply a grant, because Practice Makes Perfect didn't show a strong cash flow from their projections and were very much oriented towards providing a grant support to the students that they brought in for their summer internship and essentially summer school to improve the next year's educational performance. All right, so what does this all mean to you? It means that you need to go back to that one view, and I think it's important for you to remind yourself of that one view for what your history of profit and loss has been, what your history of operating expenses has been, where you are today in 2016, and then what you would forecast for the ensuing 2 or 3 years, especially assuming you receive the kind of capital that you're after. So this gives a great deal of confidence to your prospective investor. The confidence helps them understand clearly what you need, what your exit rates have been out of your previous financial period, reporting periods, and then finally what the use of proceeds, which is their term, an investor's term, for how will you use the money to grow your business, and then what will that result in. So really focusing on a clear explanation of that. You'll see in the bottom of this chart, I'll remind you again that they're also disclosing whom you've received money from in the past, what terms are still outstanding, did you pay back the debt or is it still on your books? All of that is going to be of interest to your prospective investor. Okay, so deliverables, what you have to do, last swing of the bat, as I said, is to go back and revise your funding ask. Then I want you to, with that, update your financials and then update your business plan deck to, as you pitch it, to reflect those. In the funding ask, remember, it's the funding amount first, it's the type of capital. Is it a grant? Is it a debt? Is it debt with a risk, variable payment obligation? Or is it equity that you're looking for? And then how will you use that? Where will you invest it in your company? And then finally, what would the investor return be? Both on a financial return and on an impact return. So with that, I will say thank you and good luck. I'll look forward to seeing you and meeting all of you here in Santa Clara in August.